Hello everyone on this webinar. I am glad to see everyone here. I appreciate you coming to this webinar, which is titled Multidimensional Trading Part 1. My name is Stanislav Bernehoff. I'm a full-time trader with over 11 years of experience in trading Forex, futures, CODs and options. And today I'm going to share with you some interesting information concerning trading that might help you in making better decisions in your daily trading routines. The title of this webinar is Multidimensional Trading Part 1. In a nutshell, this webinar will be dedicated to combining different time frames together. Too many times traders just follow the price. They go after the price and they got caught in the choppy markets and in situations when the breakouts are false, and they give their profits back to the market very quickly. To avoid that, we should build some kind of context that will take into consideration bigger picture. We want also to know what is happening on higher time frames, not only just our working time frame like H1 or M15. I don't know what you are using in your trading. And to get the holistic view on the market, we have to combine all these time frames together simultaneously. Watch reference points, take into consideration different scenarios, define potential for certain trades, and so on and so forth, and do many things. In the series of 2 webinars, we will talk about that. I will try to dig deep into this topic and share with you some insights about this very important topic: how to combine different time frames together, how to get the holistic view on what is happening. And traditionally, before we start, let's take a quick look at the disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial, and you accept full responsibility for any of your trading decisions. Past performance is not a guarantee of future returns. With that, we are ready to start the webinar. Let's start with the concept of complexity. It's been said in some trading books that there are bulls and bears in the market. Some group of traders is more aggressive, they are buying. Some group is more aggressive in selling, they push the market down. While the other group is opposing them, and it is everlasting fight between bulls and bears. Well, basically it is right, but it's oversimplified approach to trading, because actually there is no one group. There are many groups operating in the market simultaneously all the time. For example, scalper or intraday trader can trade with long-term trader. Swing trader can trade with hedgers or exporters or other non-speculative traders that nevertheless operate in large volume. The market is a huge pie where different groups come together and interact with each other, and to successfully analyze the market and to successfully build appropriate context and know how to generate good trading decisions, we have to take into consideration this complexity. We have to at least know how to identify or how to distinguish difference between 2 groups. The one group is daytime frame traders, which are the most active on any asset, on any trading instrument. They are most active, and other time frame traders, which start from 1 to 3 days, 1 to 5 days horizon, and more. If we know how to distinguish these 2 groups, on the one hand it is intraday traders, on the other hand it is other time frame traders, we already can be better decision makers than the majority of traders. And this webinar will be dedicated to this topic. We will watch charts, we will watch real trading situations from the past that were made on my account, on the accounts of my students, and I hope that it will be useful for your decision making as well. And let's synchronize definitions. In this webinar, when I'm talking about time frames, I'm not talking about charts like M5, M15, 1 hour chart, 4 hour chart, and etc. By time frames, I will assume traders with different horizons, different goals, and different resources. For example, day time frame traders will close their position before the day ends. Other time frame traders, or I will call them OTF, other time frame traders, will hold their position overnight, and we can track their traces on volume and open interest and some other charts. Also, there are long-term traders. By long-term traders, I will assume traders which are in positions from 1 month to 6 months. Well, this distinction is pretty much nominal, because you never know how much time, how big horizon do they have. We don't know that, because sometimes markets are choppy. They are trading in a trading range for the very long period of time. They are not trending, and they're very much market participants can be in positions waiting for the breakout, and they hold this position for long enough. But by time frames, I will assume traders, not charts. There are basically two approaches for analyzing different time frames. On the left hand, you see multi-screen analysis or charting approach. It means that you combine different charts together. In this particular example, I've combined M30, 30-minute chart, and daily chart. So that's what I'm doing on a daily basis. I always watch not only 30-minute chart, but also daily chart. You can take another chart, so it is so-called three-screen approach. When you put a large time frame like daily chart or weekly chart, then you go top down, watching what is happening on lower charts, and you can end up analyzing 5-minute chart or 15-minute chart when you make your decisions for entry. And the second one is reference analysis. I call it reference analysis. We anticipate behavior of different groups of traders near some important reference points. So we actually are not analyzing charts in conventional manner. We are not building trend lines. We are not analyzing price action by candlesticks. We just watch what is happening near some important reference points. Reference analysis. Let's start with charts. I don't want to bother you with different definitions, with the theory. Let's start with the practice, with the charts. When I start analyzing the market, what I do in the first place, I start watching daily chart. What is happening on the daily chart? Sometimes it is weekly chart, but I am not very long-term trader. I'm a short-term trader. That's why I watch weekly charts, but not very frequently. So daily chart is my basis for making trading decisions or analyzing important trade locations. Here on the slide you see the currency pair of Australian dollar versus American dollar. It is daily chart, and what I want to pay attention to first is long-term extremes. Long-term highs and long-term lows. Of course, you see that long-term low that was established in January 2016. We see it around 0.68. It is pretty much distant from the current price action. So we keep this in mind. But actually, there are a few odds. Well, odds are very slim that the market will go to this point very quickly. Well, the other level is located closer to the price action. It is 0.7835 or so. It was established in April of 2016. Well, why do we pay attention to reference points like extremes? If you remember about time frames, about traders with big horizons, with large operating the large money, they pay attention to such reference points. They even don't care what is happening inside of this trading range. When they see that the long-term extreme has been broken, they can activate some of their orders. They can reassess their analysis, their forecasts. They can sometimes play a breakout momentum trades, because when you have very big volume and you are still a momentum trader, long-term trader, sometimes they even rely on weekly chart. And you see that if they rely on weekly chart, they will treat the breakout of this high as an important signal for possibly entering the position here, or closing their previous positions that were short positions, that were short trade. There are also other traders which will also play a breakout momentum trades to the upside from this level, and also not only them are interested in this level. There are traders which are already keeping their shorts, their inventory is net short, and they are placing their stop above this level. If you automatically know that many time frames and many traders will be interested in this trade location, market will possibly visit this trade location just for the purpose of facilitating trading. The goal of the market is to facilitate trading. If market as an auction just goes back and forth around some around some level, around some trading range, and liquidity dries up, eventually it will go to the point where liquidity is more visible, where many traders will trade, and they will bring volume to the market. And that's why markets are visiting such points. Just let's take a look on the previous market action on Australian dollar itself, and see how actually market was trading in June and July, in August, and so on and so forth. First of all, we have seen that the intermediate term low was established in May 2016. It is really intermediate term low because it is not long-term low. It is intermediate term low. It's also a reference point that will be important for the market. Then market has gone higher, established intermediate term high, pulled back, also then generated a rally to the upside, and made again intermediate term high in June. It was June 23rd, and that's the way we have several reference points here. See what happens when the market breaks out the level of June 23rd. What do we have here? Market is going up. First we have a first test, then it breaks this extreme and reverses immediately after that. Well, it's not a big reversal, it's not a big deal, but market reverts to the mean, so it goes back to the trading range. Actually, it is a point where we can search for a short trade. It is a trade location where opportunity is underway for us for the short trade. Then market also had generated some rally. Again, it has tested area above previous extreme. The new extreme was established in July 15th. It is also a reference point. Market has broken this reference point. We had minor rotation here, and again it has reverted to the mean. It has reverted back to the trading range. So also it is a point where we can search for a short trade, search for an opportunity. You would say, how do we know that market will visit this area? That's the first question. And the second question, how do we know that the market will not break this area and will not go to the upside? Well, to answer this question, we should go outside of the chart and see what was happening with the open interest. Actually, when the markets are breaking important extremes, when market is breaking a reference point, it is breaking reference point when we have some large time frame involved in the game. When you see some large time frame involved in the game, possibly the odds are greater that market will go higher, because large time frames are not paying attention to such short-term reference points. They are not even they don't take this into consideration. They are careless about those monthly, even maybe 2 weeks or 3 weeks extremes. They are careless about them. They're heading right to the important levels like 0.78. They're heading for very important points. They are careless about those short-term points. So how do we know that markets will possibly reverse or not go higher? To answer this question, let's go to the website www.timingcharts.com. I was showing you this website so far in previous webinars. You may already know this website, so I use it in my analysis very frequently, thanks to the creators of this website. Well, you also can use barchart.com and other websites visualizing the data from COT-reports. If you don't know what is COT-report, I recommend you to watch previous webinar Unconventional Fundamental Analysis or similar webinars on this point, on this topic. I want to push the button COT. So what do I have here? I have here three lines: green, blue, and red. And also I want to see what was happening on the day June 24th. June 24th, yeah, right here. We had reference point on June 24th, right? It was Brexit. And our previous reference point was June 16. It was June 16. What was happening after that? After markets were heavily liquidated here, and then they got back to the average of this trading range. It was July 1st. It was July 1st. See what is happening with the delta of open interest on the July 1st. It's July 1st, okay. Actually, now July 5th. Okay, sorry about that. July 5th. Information was available after July 5th. So it was released July 5th, and we have got this information after July 8th. July 8th. So here we already know what was happening with the COT-reports. The delta was very, very balanced. The large traders were holding short positions. Sorry, I'm not showing you the right chart. Large traders were holding, they were net long on 4,903, and commercial traders were short 8,000 contracts and 961. So it is not a big deal. It is absolutely not a big deal. It means that market was very, very balanced. In other words, the number of contracts for the short positions and number of the contracts for the long positions was almost the same. So in other words, market was very balanced. So no big time frame was involved in the game. Market was balanced. In other words, if market was ready to break out to the upside, possibly we would have seen the difference, the larger difference in delta. So the large speculators would have accumulated not 4,000 contracts, we would have seen 20,000 contracts or 30,000 contracts. So the delta would be more significant. During that time, it was not a big deal. So market was balanced. In other words, who were dominating the market back then? They were short-term traders, swing traders. They were bringing their small volume, and they were generating small rallies, and of course they want to close their position on a short-term reference point. Of course they want to get outside of their position, exit that position once market reaches the border of the trading, short-term small trading range, because no big time frames are involved. So they sustain, they keep this rally 1, 2, 3, 4, 5 days, and that's it. The game is over. They exit their positions. No, there are no other traders that are willing to keep this rally going forward. That's why we see such kind of action. So market just breaks the reference point and immediately reverses, and we see the descending swing. 1, 2, 3, 4, 5 days. 5 days swing to the downside. Let's switch to the lower time frame. As I have said, we are combining different time frames together. So you place your daily chart and you see that market is breaking this reference point at the moment. What was happening on that day on the lower time frame? I mean, it was July 15th. It was July 15th. Let's switch to 30-minute chart. You may use 1-hour chart or even 15-minute chart, I don't know, but I'm using 30-minute chart in my trading every day, so that's why I'm showing you this time frame. All right, July 15th. Okay, July 15th. What do we have here? Oh, sorry about that. I will scroll my chart back once again. That's what we have here. So that's a primary breakout, July 12th. The markets they are generated a small pullback. Again, we have a shakeout on July 15th. We have a shakeout here, and eventually we see no continuation here. And do we have any setups here to the short side? Well, of course we have a level 1.7658. We have this level, market is reacting to this level, and as you know, we want to search for the short position. What do we have here also? You may notice that the ATR, or average to range indicator, has shown you the lowest value for the period of actually 3 days. That's day number 1, day number 2, day number 3. So volatility is going down. This shakeout is predictable. Yet you can plan some of short trades to the downside using this level. Okay, you have a level here, and you may also search for a short trade once this level is not broken out to the upside. You may even watch the 4-hour chart. 4-hour chart sometimes is better tracking such kind of setups. That's the way it is. Well, I must warn you that different brokers, they have different terminal time, so that 4-hour candlesticks will look slightly different on each time frame, on each chart. So what do we see here? How can we use the 4-hour chart for the sake of our analysis? Well, we see very big formation, the engulfing formation here. It's very huge. So I'm not sure that we can use it, but it is a reversal pattern. Actually, it's a reversal setup. So how can we use it? We search for a pullback. We place a short trade somewhere in the center of this pattern, and we place a stop order above our high, above the high of this section. Not above the high of this section, above the high of this setup. So that is the setup. That is the highest value of this setup, the highest point. Market pulls back, you place a short trade, you place your stop, and you go with the market, you go with the price. Well, if you use 4-hour chart, your profit loss ratio must be relatively lower than for other time frames, smaller time frames like M30. You can achieve here a 3-to-1 profit loss ratio. But you know that the market will get back to the previous range. That is very important understanding, because you know that nobody was really involved here. Do you remember that we were analyzing the market? We know that here markets were very balanced. Shorts and longs are balanced. So number of short positions is almost equal to number of long positions. So market goes higher, and you know that possibly swing traders are responsible for that action. So they will try to close their positions entirely at the top of this trading range. What about August trades? Seemingly, we had the same situation. We had breakout of important reference point, which was established in July, but the situation is pretty much different. This time market is not reversing very quickly. First it builds consolidation area before going lower, and then it even tests this consolidation area with a rapid rally that can wipe out us from short positions very quickly. What about this point? Why market is not reversing so quickly here? Why it is rather building some consolidation? Why is it rotating for a period of several days? Actually, it is 7 days or so. It is rotating, then it is testing with a very rapid breakout to the upside, then it goes down. Why is it so? Well, we might not have a direct answer on this question, but when the market was located here on August 9th, we have seen that the delta, or the difference between short and long positions on his COT reports, was already net long. In other words, speculators, which is green line here, they were holding long positions more than short positions. I don't know why this happened. We should watch the reports itself. Maybe short sellers, they have exited their positions, or maybe some large market participants, large time frames have brought the volume to the market. They have accumulated some longs, but nevertheless, market was not long. So market was not ready to reverse very quickly. So possibly there are now not only swing traders responsible for this action or involved in this action, but also larger time frames. I don't know who they are, but larger time frames, they were also responsible for that rally. That's why we should think twice before going short here, because we say, okay, so the odds are the odds are not very good for the short trade. Possibly they are 50-50. We don't know. Market could have broken out more rapidly to the upside, so going against this market, fading this action, is possibly not very wise decision. And here is another chart that is pretty interesting. I was showing one of these charts in previous webinars. It is American dollar versus Mexican peso with the ticker of USDMXN. It is pretty interesting market that is trading on its own most of the time. It is not correlated with the majority of other markets, yet it is correlated with commodity assets, with gold, with Canadian dollar. And I want you to pay attention on the breakout of several reference points which has occurred at August 15. First of all, we had several reference points here in June. It is also June 23rd and July 1st. Two reference points are in place here. We have a line here, and market starts moving lower, and eventually has broken this level. What do we want to know? We want to know whether the market was balanced before this rally. Was the market balanced before this rally? In other words, were traders involved in this action, in this rally, are bringing significant volume or not? In case we had a large time frame involved in the game here, market would possibly not reverse so quickly. It would start consolidate, maybe it would start to go lower and lower. So going long here would not have been a very good decision. So imagine that we're here or somewhere here, and we want to know whether big time frame is involved here. Also, we open this chart in www.timingcharts.com. We choose Mexican peso future. Remember that we are not watching Forex here, because it is not centralized exchange. It is not providing us any meaningful information about the volumes and open interest. We choose Mexican peso here, we choose COT-reports here, and you might notice that this chart is turned upside down in comparison to the Forex chart, because it is Mexican peso versus American dollar. And on the spot market, we have American dollar versus Mexican peso. So these charts are similar, but they are turned upside down. Okay, so that's August 11, August 12, August 15, and August 16. So we wanted to know what was happening after before the August 9th, when this rally started to go from inside of this trading range. August 9. So what did we see here? We have seen here that market was not balanced, but the inventory of large speculators was not short. It was not short. It was minus 54,362 contracts. It means that actually market was not preparing either for the long rally, it was preparing for the short rally possibly. Well, when we are located in the center of the trading range, delta of open interest is not very meaningful, because volumes and open interest are going back and forth, they're increasing, they're decreasing all the time, but nevertheless we have seen that no big time frames were involved, at least in the speculation with the peso on the long side. Even if they were preparing for the short rally, they were not preparing for the rally to the long side. So we might say, okay, when the market is breaking on August 15th, on August 16th, at least market is not preparing for, is not accumulating long positions here for peso, and short position in American dollar versus peso. So we might start thinking about going short here. What about recent rally, which is now underway? We see that June 24th we had reference point. It was broken out during September 16th. Market is not reversing for right now. We want to know whether it is good point for placing, actually for going long on peso and going short on American dollar versus peso. Is it good or not? So the question is it current trade location around 90.67, 86 or even 50 is good for establishing a short trade on American dollar versus MXN, on Mexican peso? And again, to answer this question, we want to see what's happening with the delta, and we see that this time the delta for the big speculators, for the large traders, were increasing on the short side with the falling or with the descending price action. So in other words, price is going down and delta is also going down. And now we see that delta for September 27th was minus 85,873 contracts. Well, first of all, it is a new low. You might notice that it is a new low in delta for some period of time. Let's watch larger, bigger picture, and you see that that is a new low since 2015, since November 2015. It is a new low. So in other words, some big time frames is possibly involved in the game here. It is holding lower prices here. You see the big sellers were stepping in. You're stepping in during the period of previous 2 or 3 weeks. They were stepping in. They are holding short positions for right now, and possibly market is not going to reverse very quickly. It is going at least to consolidate, or I even expect the further breakout, the further continuation. Multidimensional analysis is not always showing us what to do. It is also showing us the now less important thing, what not to do, because what not to do in trading is now less important than what to do, because in trading our primary goal is to filter a lot, to focus on good trades and to eliminate bad trades, to do more of what works and to do less of what doesn't work. And this time I don't see any good entry point on American dollar versus Mexican peso. I would say more that I was capturing some pullbacks here in attempt to build a long position, but this time is not working. I have closed my position in a break even. But what I will not try to do here, I will not try to go short. I will not try to go short because I know that this large time frame that was possibly pushing prices higher here, well, it might be in the game. It might be active for right now, and it is not wise decision to go against this time frame. So I would say even more that not only during this rally, but during the whole action until September 27th, this time frame was in the game. So going short is pretty dangerous here. You are going against the big market participant that might possibly continue pushing prices up here. So if I want to choose a destination, I would rather choose the long side. I would rather choose to buy here rather than to sell. But if I don't see any entry point on the chart, if I don't support my view on the chart with some chart pattern or analysis or technical analysis, of course I will not enter this trade. At least I will filter my short trade, which is very, very important. As I have said, filtering is no less important than making a trade. what we don't do is more important sometimes that we do. Let's repeat once again what we are going to monitor in the market, applying such a reference analysis that I was showing you so far here in this webinar. First of all, we want to see where are important reference points located. We want to mark those reference points. Then once market breaks those reference points, once it penetrates the area above or below these reference points, we want to know who was involved in the game, who was responsible for the breakout. To analyze that, we are going to the COT-reports, to the timing charts, and see whether the market was balanced or it was driven by larger time frame here. In case market was balanced, the odds are greater that market possibly would reverse and would not hold above the level. Let's, for example, watch Canadian. It has broken out important reference point on 1.3250. 3250. The breakout was here. Now we have a pullback. Let's watch what was happening with this market. We see here that situation is pretty much more complex than for the previous setups. First of all, before the market generated this rally to the reference point, before it has taken this low, it was net long. The market was net long, so possibly the majority of speculators were preparing for the bullish rally on Canadian dollar and bearish rally on American dollar versus Canadian. So now it is balanced. Now we have the 0 point. So I would not say that large time frames are involved in selling here. So possibly they have just closed their positions. And I would say that we have seen it only before September 23rd, which was a week ago, the week ago, and now I would say that odds are greater for market getting back to the range rather than sustaining this bearish rally to the downside. Everything can happen in the market. But I would say possibly that I would not search for long trades right here on Canadian dollar. I would not search for long trades. Instead, I would possibly try to monitor for such short-term setup to play a counter trend or reversal trade, to bet on the scenario that market will possibly rather get back to the average or get back to the previous to this trading range rather than break out to the upside. So as you have seen, nothing significant was happening on the Canadian dollar. So I would say that possibly it has better odds of a mean reversion scenario. Now we're finishing the first part of this webinar. I appreciate your time and your attention. We will continue talking about this topic in the next webinar on this topic. It will be multidimensional trading part 1, so keep in touch. And as the video will be recorded, you will be able to watch it and leave your comments below. Now if you have any questions, you can leave your comments below this video and I will do my best to answer them. I wish you all the best. Trade responsibly, manage risks, and thank you for your attention. This webinar was prepared by Stanislav Bernhoff and Exness Company. Good luck.